All right, so now question number 2 is relating to chapter or week 5, absorption and marginal costing. As hope you could remember, we prepared two different income statement and compared the profit, and also we prepared a reconciliation statement reconciling the profit that we have calculated based on absorption costing and marginal costing. So two different costing system. Uh, as you could remember, absorption costing is a full costing or traditional costing system where we consider the full cost of manufacturing a product. That means the total cost of manufacturing a product, uh, fixed cost and variable cost. But in case of marginal costing, we consider only variable cost of manufacturing product in case of calculating product cost or manufacturing cost. So let's see the example given here. The following details have been extracted from the budget of Gold PLC. Selling price per unit is 200, variable production cost per unit 75, and fixed production cost per unit is 40. A budgeted fixed production cost per unit was based on a normal capacity of 12,000 unit. All right, so these are the budgets actually. So we budgeted to produce 12,000 units, sales price 200, variable production cost 75, and fixed production cost 40. Actual data relating to November and December 2020 are given below. So production volume in units, actually we produced 11,000 in November and 12,500 in December. Sales volume 10,800, 12,200 respectively in two different months. Sales price 185 and 210, and variable production cost 75 and 75, and fixed production cost total budget is 450,000 and 470,000. These are the actual data. And there was no closing inventory at the end of November 2020. All right. Okay. So required calculate the actual profit for November and December using absorption costing. Assume that any under or over absorption of fixed overhead is debited or credited to income statement each month. And obviously over or under absorption will be created because of our what it call budget and actual discrepancies, the difference between budgeted production and actual production. As we have budgeted 12,000, but actually we produced 11,000 and 12,500. So if we produce less, obviously it will create under absorption. If we produce more, it will create over absorption. And if it is under absorbed, then we have to add the remaining cost, or that is fixed cost. And if it is over absorbed, we have to deduct. All right. So yes, let's see. So I don't know. There was no closing inventory. The end of November. Is it end of November? I think it should be October. Yeah, and there is no beginning inventory of November. It should be, because we produced 11,000 and we sold 10,800, and obviously there should have some ending inventory, 200 ending inventory, and that should be beginning of the next year, next month. Okay, so I don't know, this should be beginning of November. Yeah, and calculate actual profit for November and December using marginal costing, and here calculate actual profit based on absorption costing, and then we have to prepare reconciliation statement in requirement C. Okay, so let's see absorption costing income statement. So this is the column where we will calculate, and then this is the final column for November, and this is the working column for December, and this is the final column for December. So sales revenue and the actual sales price 185 for November and 210 for December. So if you multiply it by number of units sold, 10,800, you will get 1,998,000 of sales revenue in November, and 12,200 is the sales amount in December. So multiplied by actual sales price 210. So 2,562,000 is the sales revenue in December. It's very simple. And then we have to calculate cost of goods sold. Cost of goods sold, as there is no beginning inventory in November, so should be 0. Okay, and cost of production. And in case of absorption costing, we have to consider all the cost, fixed cost and variable cost of product. So fixed production cost and variable production cost, if you add these two together, 115 is cost per unit. So 115 per unit cost, and the number of units produced is 11,000. So if you multiply it by 11,000, it should be 1,265,000. Okay, and in case of December, we produced 12,500. So multiplied by 115, it should be 1,437,500. Okay, and then closing stock. So opening plus production minus closing stock, then we'll get cost of goods sold. So closing stock is, so we produced 11,000, we sold 10,800 in November. So 200 is our ending inventory in November. Okay, so 200 multiplied by 115. So it should be 23,000 is the ending inventory. If we deduct it from here, so you will get cost of goods sold 1,242,000. And this is 23,000 is your ending inventory in November. So end of November, that means it will go to the beginning of December. Next month is 23,000 beginning inventory here. So this one should be added with production. So beginning inventory plus production minus ending inventory. Okay. So in case of December, how much is ending inventory? So beginning is 200 and production 12,500. So 12,700 total, and we sold 12,200. That means 500 remaining. Okay, so should be 500. So 500 times 115. So it should be what's called 57,500, isn't it? Can I show you calculator? Where is it? Slow, very slow. So 115 times 500. So it's equal to 57,500. Yeah. Okay. All right. So and then after it just beginning plus production minus ending, it should be 1,403,000. All right. And then come to overabsorbed or underabsorption. Okay. So our budget was 12,000. All right. But actually we produced 11,000. Okay. 11,000 units we produced. So 11,000 multiplied by 40 per unit fixed cost given in the question, per unit fixed cost. So we actually absorbed 440,000. Okay, 440,000 we actually absorbed, but budgeted fixed cost for November, actual fixed cost for November is 450,000. Okay, so actually we absorbed, we recognized 440, but actual cost is 450. So 10,000 is under absorbed. Okay, so we have to add this under absorbed cost here. Okay, so 1,242,000 plus 10,000, that is 1,252,000 is our total cost of actual cost of goods sold. Okay, according to budget, this is cost of goods sold, but actually our cost of goods sold is this, because we did not consider this 10,000, we did not include this 10,000 in our cost of production, and that's why we have to add this. So this is our actual cost of goods sold. If we deduct it from sales revenue, this is actual profit, 746,000 profit in November. In December, we produce more. Okay, actual production is 12,500, but our budget was 12,000. Okay, budget was 12,000. So we produced more 500 units, that is over absorbed. Okay, so 12,500 multiplied by 440, this is what we absorbed, but actually this is what our actual fixed overhead. So we over absorbed 30,000. This is what actually is not our cost. So this is what we need to deduct now. So deduct 30,000 from budgeted fixed costs. So 1,373,000 is our actual cost of goods sold. So if we deduct this one, then we will get 1,189,000 is our yeah, 1,189,000 is our profit. Okay, I hope you're under absorbed and over absorbed, and remember, under absorption and over absorption is only can happen in absorption costing. Nothing this kind of calculation is relating to, will not relating to marginal costing. Okay, because marginal costing doesn't include fixed cost in cost of goods sold or product cost, and that's why it will not create any under absorbed or over absorbed in marginal costing. So what we absorb means how much we recognize, how much we recorded, right? So how much we produced, this is what the production cost. In our production cost, we recognize this amount of fixed cost, right? 11,000 times 40. 40 is the fixed cost per unit. This is what is included in 115. Okay, but actually cost is 450. So we recognized 440, right? If you multiply it, if you say 11,000 times 40, it is 440,000, but actual cost is this. So there is a difference. This is what we need to adjust. So we showed 440, but actual cost is 450 actual cost. So we need to add 10,000. We need to include it. But in case of December, we recognized more. All right. So 12,500 times 40, it is 500,000. Okay, but our actual cost is 470,000. So we need to deduct this 30,000 because we recognized, we showed 30,000 expenditure more. So this 30,000 is not actually our cost. All right. Right. Marginal costing. In case of marginal costing, so sales revenue is exactly the same figure, just we may copy it from here. So 1,998,000 and 2,562,000. So this is what the sales revenue. All right. And then we have to deduct variable cost of goods sold. And in case of variable cost of goods sold, we will consider only variable cost of production, right? Marginal costing or variable costing, only variable cost. So opening stock 0, as the question says. So, and then what about our production cost? Cost of production in November. So we produced 11,000 times 75, and we produced 12,500 in December, 12,500 times 75. So these are the figures you will get. And in November, it's the same as we had before. So ending inventory is 200 times 75. So it is 15,000, and in December 500. So 500 times 75 is 37,500. So, and the ending inventory of November 15,000 is the beginning inventory of, or opening inventory of, December. All right. So as we did before, so opening plus production minus ending inventory is our variable cost of goods sold, and the same here. Okay, so if we deduct variable cost of goods sold from sales revenue, you will get contribution margin, right? This is variable cost. So sales minus variable cost is contribution margin, minus fixed cost given, actual fixed cost total, right? So 450 and 470,000. We do not need to adjust over or under absorption because actual fixed cost we are deducting from here. Okay, so that's why 738,000. So contribution margin minus fixed cost is 738,000. Contribution margin minus fixed cost 1177,000 is our profit under marginal costing. All right, now what we have to do, we have to prepare a reconciliation statement, right? So reconciliation means we have to check whether our calculation is right and why the difference actually has been created. So the differences between the profit in November and December. So firstly, we are recognizing the profit that we have calculated based on absorption costing in November and December, and profit under marginal costing in November and December. So what is the difference? Differences are 8,000, right, and 12,000. All right, and then let's see what's the difference between inventory valuation in November. So closing minus opening in November is 23,000, and under absorption costing, remember. So if we recognize absorption costing here first, we have to recognize absorption here first. And again, December closing minus opening. So closing minus opening is 34,500. And under marginal costing, again, in November, closing minus opening is 15,000. And in December, closing minus opening is 22,500. So closing minus opening. Okay, so what is the differences between inventory valuation is, so 23,000 minus 15,000 is 8,000, and 34,500 minus 22,500 is 12,000. So we can say the difference between profit 8,000 and difference between inventory valuation in November is 8,000. In December, difference between profit under different that is absorption costing and marginal costing is 12,000, and the difference between inventory valuation in December is 12,000. So it is reconciled. So that means the difference in profit calculation, the differences in profit calculation under two different costing systems actually been created because of inventory valuation, right? Only the inventory valuation has created this difference, right? So hope it is clear to you. If not, then you can contact with us, and we are happy to answer if you have any question. Thank you very much for watching, and other part I'll discuss in the next video.